Welcome to Full Speed Ahead. I'm Craig Fuller here with Bob Farrell, the CEO of GlobalTranz. Bob, welcome to Full Speed Ahead. I think it's the first time we've had you on.
Yeah, I think that's right. I've been on What the Truck with some of your friends, but not on with you. So great to be here.
Yeah, likewise. Great to have you. You came into the industry a couple of years ago and were a part of building GlobalTranz into one of the largest and most innovative companies in the space. Tell us a little bit about your background. You were a healthcare guy, if I'm not mistaken.
No, actually, I'm a technology guy. Prior to being the CEO of GlobalTranz, I was the CEO of four different software companies, or in one case, a platform company, which was great. That was a great match for GlobalTranz. Since Andrew Leto founded GlobalTranz back in 2003, it was a very technology focused company, and in 16 we really sharpened that focus even more. And everything we do through a technology lens. And I know everybody says that, but we actually try to walk that talk.
When you talk about technology, is it helping customers be more efficient in how they route freight? Is it building deeper digital matching? Where is the majority or the focus of the company in terms of technology?
So it's really all of those things. First and foremost, I would say, particularly over the last 12 months, or really 24 months, our customers have focused more and more on looking at our technology to provide them with a solution to get their SKUs closer to their customers, where they need to be, when they need to be there, at the right time. So creating technology that really facilitates all that. So for GlobalTrans, what that means is that we've had to evolve our TMS to be not only really strong in the back end of things and in our ability to match shipments to carriers and to provide all the back office operations that a 3PL provides, but to offer the front end shipper the opportunity to do data analytics, to use AI to drive optimization, to look at new ways to move the freight, to really consider things that could be done to their supply chain to maximize the turns in inventory, to really create a financial environment that gives them a competitive and operative advantage. I would say that right now, so much of what we're doing is data driven and having analytics, not only for reporting and dashboarding and those kind of things, but analytics to drive decision making in real time and to do things like digital freight matching. A big part of what we're doing.
Now, is GlobalTrans is historically, or at least has been an active participant in the agency model, an agency market. But I understand that there may be you guys are really organically building your own operations. Is the agency model a key part of growth, or is it the goal to really bring a lot of that those resources in house?
So we have a hybrid go-to-market. So we do, as you said, go-to-market via an agent channel as well as a direct channel. In 2020, about 40% of our gross revenues came from the agent channel and 60% from direct. We love both models, particularly during the pandemic. Having an agent model really gave us a cost variability that was nice to have and really allowed us to power through without having to do any reductions or anything like that. But we think there's value in both models. Typically, although not always, but typically our agents are focused on the SMB market. They're dealing with customers that are local to where they're based. Often they're people that they go to church with. They're people that their kids are on the same soccer teams, and they build these really deep and tight relationships that are very sticky and last for a long period of time. So, those agents are using our platform. They're using our visibility into capacity. They're using our back office to drive all their business, and it's a very important part of our growth, and it's a very important part of our business today. On the direct side, it's a little bit more enterprise focused. In recent years, the most significant growing part of that direct business has been our managed transportation capability. So today we have over $500 million in freight under management as a 4PL. And some of that we do the 3PL work on, and some of it we don't. And so those are really kind of different businesses, and those channels coexist very well.
So, Bob, when you think about the future of the industry, there's been a lot of talk of consolidation. GlobalTranz has been a key contributor and beneficiary of the consolidation in the market. Are you guys still actively doing consolidation and acquisitions?
Absolutely. So, growing through acquisition is still a strategic pillar for us. At the moment, we actually have two LOIs out. Valuations are becoming more and more challenged. We've got a lot of private equity out there with a lot of money to put to work, and we're private equity owned ourselves. So, we're supported by our private equity partners, and they're anxious to help us do accretive acquisitions. I think there's a lot of value in scale when you look at the truckload side of the business, which for us is about 60% of our business. Um, Getting visibility on that capacity across a broader base really allows you to serve customers better. So when we acquire or consolidate in a truckload brokerage or somebody who has a truckload brokerage as part of their business, it just expands our capacity across the whole network. From a technology perspective, we spent a lot of time to make sure that anybody who we acquire can immediately get visibility into that capacity. So I think that this will be a pretty robust year. There are a lot of deals out there being run by bankers, and there's a lot of deals out there where folks who have been in the business for a while are perhaps looking to create liquidity, and they're open to having sort of one-on-one discussions. Where we look at acquisitions from three perspectives. One are companies that we can consolidate into our business model. So we move their customers onto our platform, we move their back office into our back office. It's very consolidation oriented play. The second are more transformational acquisitions, and those are ones where we'll bring in a new mode, we'll bring in a new capability. In May of 17, for example, when we acquired logistics planning services, that was the start really of our managed transportation capabilities. When we acquired Ceresis in January of 20, it was an addition to that. And then the third category is actually acquiring our agents. When our agents are looking to retire or looking to do the business differently than they've been doing, perhaps they've gotten bigger than they ever wanted to get, and it's an opportunity for them to create some liquidity, we'll look to acquiring them. So we're pretty active and look forward to trying to drive some deals here in 2021.
Now, you mentioned that you're looking at deals right now. Any sense of or anything you can share with us on those particular deals?
No, obviously we're under NDA for anything that we're looking at specifically, but there are a lot of good assets out there that for one reason or another they're at a point in their cycle where they're either looking to change private equity ownership. The original PE is looking to create liquidity. You've got a lot of founder, many times family-owned 3PLs out there where the ownership is ready to retire and there's no family members ready to step in, and those represent opportunities. And then there's others where they're just feeling the effects of being smaller and how much more difficult that is in terms of on the LTL side getting access to rates. LTL carriers are reducing the number of 3PLs that they're working with, and for smaller 3PLs that can be a challenge. So by bringing or consolidating a business into a GlobalTranz, they get to take advantage of our scale on that front. So I think that there's a number of deal dynamics out there, and there's going to be some good opportunities.
Has capital gains changes come up in any of the conversations? Are you seeing founders that have built substantial enterprises say this may be the year to take some money off the table because I don't know what's going to happen to the tax law next year?
So I haven't heard that specifically, but I have to imagine if I was one of those individuals, I would be thinking about that.
Yeah.
So I don't know where things are going to go, but if the first digit of the new capital gains is a 4, that's a major change. Even if it's a 3, it's a major change from what we've had in place now for some time. So I would imagine that if anybody were considering doing anything in the next couple of years, now would be a time to accelerate and try to take advantage of capital gains as it is today.
Yeah, just a quick math. If it was a $100 million business in terms of capital gains, and you were to sell it this year on December 30th, assuming the tax law changes next year, you're talking about a $24 million tax bill versus sell it next year, and you're talking about a $40 million tax bill. So it's a significant delta. And then, of course, you have state taxes. So I can imagine founders are certainly looking at that. We'll probably see a lot of deal activity at the end of the year, assuming that there is a capital gains change, which is certainly uncertain. Bob, what is it about particular businesses when you're looking at acquiring these companies? Where do you guys really focus on and try to understand how this business is going to fit? And where do you put a lot of value in a potential transaction?
Well, we start with a cultural review, and I know that sounds kind of soft and loose, but the reality is, if in the first meeting that we have with somebody that we can't imagine bringing these companies together, and forget about the details, but just can you imagine how you would integrate these two companies together, how the people would get along, what the core values are, how you operate the business, what matters. If we can't ascertain those kinds of things right out of the gate, then it's going to be hard for us to want to spend any money or time on looking at the deals. The second is technology, and how much technology have these companies used in running their businesses to the point that they're at. In some cases, when the answer to that is not so much, that can be good for us, because it's an opportunity for us to bring our technology to bear on these businesses, and to perhaps find a way to improve efficiencies and productivity right out of the gate. In other cases, where the other player has significant technology and has done some innovation, that can be hard, because technology integrations are known to be a killer of M&A, and not, and oftentimes a dyssynergy versus a synergy. So we look at that early on. We look at the customer base. What kind of overlaps do we have in the customer base? What kind of model do we have? Are we using a carrier sales model, a buy-sell model, or are we using some dispatch model, or are they using some pod model? How much of their business is actually done digitally, 100%. So, LTL, it's always very simple, and 95% of that is automated and has been at GlobalTranz for a while. On the truckload side, we're continuing to inch up in terms of how much freight doesn't actually get touched by anybody, and that's a mindset. So if you've got a business where a lot of people are making a lot of commission and would potentially be in a position to lose some of that commission because of digital freight matching, that could create some challenges in gluing the businesses together.
Now, how do you look at the digital freight brokers or the digital natives? Because I know everyone is digitally enabled. Certainly, GlobalTranz is, as a company, a digitally enabled company. But there have been a certain class of digital brokers that have raised money at really high valuations. How do you look at those in terms of what their future would look like? Because at some point, the market is going to value them on exit. And how do you think of that sort of disparity between traditional private equity valuations, which may be on the upper end of things, versus a company that doesn't make money and still is valued quite highly?
Yeah, and we hold the Uber Freights and the Convoys and the Transfixes and all of those guys in high regard. I mean, they've done a lot of innovation, and they've sort of forced the issues with let's call them the incumbents, the GlobalTranses, the Echoes, the C.H. Robinsons of the world. And we see them on the landscape, and heretofore they have really not focused on doing business profitably. They've bought a lot of business, with the idea of creating a footprint and using technology later on to kind of drive efficiencies that I guess will allow them to become profitable. So I think they're a fixture here. I think if you looked at the amount of digital freight matching that occurs with some of these incumbents, the total of that freight is way more than what all these so-called digital freight matching companies are doing. So we've got the freight. In many cases they've had the technology, and that gap is kind of crashing down. So we're in the business of making money. They're in the business of raising money. it's quite different, but at some point in time that needs to change. So we coexist, particularly in some large enterprise shipping accounts. Um, I think that some of them have a lot more capacity than they have freight, and that's an interesting dynamic. We've rolled out our mobile app to carriers so that they can do a lot of the things they do with those platforms. Um, it's a lot cooler to do it on one of those brands for a carrier, right? It's GlobalTranz or Uber. I mean, like we don't have the Uber brand, but we've got the Uber functionality. So yeah, I think they're here to stay, and I think that at some point they got to figure out how to make money. I think the real question is where does gross profit, get driven in this business? So I don't think this goes the way of the stock market, where you've got a 9.99 trade. I mean, 20 years ago, you would have spent a lot of money to trade stocks, and now you can trade any amount of stocks for $10, $15, whatever. Moving freight is more difficult than that. Appointments get missed, trucks break down, there's labor issues, so on and so forth. So the question is, how can you maximize automation so that the only cost is on the exception basis? I think that will drive margins down over a long period of time, and I think those that can match an ability to serve with a high level of process automation are the ones that are going to really win.
Yeah, interesting point you make, because Robinhood, effectively, that's just digital. It's clearing, settlement, and digital matching in a financial market, which has a very low cost of transaction. Whereas in freight, there's a lot of exceptions that take place on a shipment, and there's a lot of human involvement and hands that are involved in it. Where do you think that we're going to see the most margin compression? Is it the highest volume shippers, the really dense lanes? Is that where pressure is going to come? Is it other parts of the market where we'll see some level of margin compression in the space?
I think in the short term and medium term, it is going to be those high volume shippers, because they're the ones that have the more consistent freight, the more predictable freight. Um, they're the ones who are already pressuring margins through RFP processes that are sometimes pretty difficult, and it really forces those who have the technology to make sure that they have the capacity from a data perspective built in and access to, without anybody having to make a phone call and say, "Do you have a truck?" So I think it does start on the top, but we think that with every lane that we start to build out, if we can get to a certain level of density, um, we will be able to operate on a lower margin. And this is going to evolve over time. And I'm speaking specifically to truckload here, of course. Um, and I think you already see it with some of these large shippers, and they're coming to 3PLs now. They want to have fewer vendors, and they want people who they can rely on to bring really effective cost to the table.
Is it visibility that's really driving a lot of their desire to consolidate vendors? Having the ability to have one platform or just a few platforms that they can get all of the data from on shipment status? Or is there other efficiency gains that they hope to get in choosing fewer vendors?
I think it's a little bit of all of those things. When you choose a vendor who also brings a sophisticated optimization capability to the table, and a planning capability to the table, and a dashboarding capability to the table, that just naturally will want you to put more freight through that. We have some customers who, even though they're not using us for the 3PL piece of all of that, are loading all of their data into our platform so that they can get some level of visibility across the entire spectrum. And that's a solution, but not a managed trans solution, because they're not giving it all to us. They're not asking us to be a 4PL, but they like the technology and particularly on the optimization side and on the visibility side. So I think that if you can deliver that, you can take on more freight. And if you have all of those capabilities, you will be able to get the capacity into your system that allows you to serve those customers better and to take on more lanes. And since I've been around here in 2016, we were always challenged in those earlier days around, man, if we bid on all those lanes, we're going to get killed because we don't have any density there. with technology now, we're able to more quickly get that density built.
What is your message to a small, maybe a brokerage that has, half a dozen people, maybe a dozen people, where they're not small enough where they can be agile and sort of, as you mentioned, the relationship basis. They go to church, it's their uncle that runs, the traffic department at a shipper, but then they don't have the scale to bring technology. Should those guys be looking at? Would your recommendation be looking at exit, or how do they survive in a world where you have to have a large level of sophistication, or you have to really be sort of on the inside of that relationship to be able to sustain things?
Barring any unique niche they may have, I would say that, and this is a little self-serving, and it's the beauty of the agent model, is that you can join a company like GlobalTranz or others that have an agent offering and operate on that platform and still have all the benefits of being a small company, operating the way that you want to operate, creating a subculture the way that you want to create a subculture, being your own boss, all those kinds of things. But you're operating on a platform that gives you access to all those things that you just can't afford to have as a small brokerage.
Yeah, that makes sense. It's interesting because I do think we'll see a lot of consolidation over the next couple of years in the space, and the mid-size freight brokers I think are going to struggle unless they are very differentiated and sort of control a niche that has a lot of human involvement. I think you have to. The highly commoditized freight, I think, is always at risk of just getting consolidated, both in margins and in volume. Bob, what's next for GlobalTranz? I imagine that your investors are looking at capital markets. It's certainly, even for a small company, we're much smaller than you guys, it comes up in our board discussions quite a bit about how do we think about capital markets and sort of the next stage. What about GlobalTranz? Are we going to see a public offering or a SPAC offering in the next 12 months?
Yeah, so I actually had firsthand experience of moving a company through a SPAC process. A company that I've been on the board of for a few years went public via SPAC earlier this year. Very interesting scenario. I don't think GlobalTranz in the short term is going to look at the public markets. I think there's still a lot of runway and opportunity for us to use private equity to continue to drive growth and to create value. Things can change always, right? The markets are always changing. It's an interesting discussion. You can't have a capital markets discussion and not have a SPAC discussion come up because it's so popular. Maybe a little less popular now, but it's here to stay. And for us, we want to keep driving our business in a way to maximize EBITDA. And as we do that, we create great free cash flow, and that is a great way for private equity to continue to invest in us. And I think for the short term, we'll just continue to look at PE as a way to drive things forward.
Do you think we'll see an active SPAC market in the logistics industry? Do you think we'll see 3PLs go through SPAC?
I would just assume by sheer numbers we should expect one to happen. I don't know that there's been any SPACs created with the specific mandate around doing 3PLs. It's a tough business to be public in, particularly the more truckload you have some cyclicality there. And having been the CEO of a public company in the past, you like to have those quarters in the bag and, have that recurring revenue that you can count on. This business isn't exactly like that. And if you draw a line for growth over a 5-year period, I think you're going to be really happy. But if you look at it in 2019, for example, you in that period, you won't be so happy. So I don't know. There's some great public companies in our space. C.H. Robinson, Echo. I mean, those are great public companies. I think that there's certainly, I know, and I've heard, in the scuttlebutt that there's companies thinking about it. We're not thinking about it right now.
I think anybody who's raised capital has talked to SPACs, at least one SPAC sponsor, if not dozens. We certainly have had our conversations with them because you have to consider it. I mean, the amount of capital that's gone into it, and the valuation delta between the private market valuations and SPAC valuations almost forces a conversation whether you want to have it or not. So it's going to be interesting to see how it works out. You make a really interesting point. I mean, the asset guys are always under pressure. When the market's good, that means drivers are short, and so that creates significant pressure on the asset side. But on the brokerage side, it's that margin compression with just what part of the market that you're in that plays havoc on the predictability of your profit margins, which can be a significant issue.
Well, I think that's where companies like GlobalTranz need to work on their mix and their modal mix, because I think that the dynamic that you just referenced is more of a truckload phenomena than it is anything else. And if you can have a strong managed transportation business where you essentially have some recurring type revenues that are volume based or subscription based, that will give you sort of some predictability, and then an LTL business that also typically has fairly consistent margins and fairly consistent volumes, that can balance off a truckload volatility. And having all of those things make you a valuable solutions provider to your shipper customers. If you don't have that truckload capability, you're not going to be able to do everything that they need. So you got to handle that volatility within the mix of business that you have to sort of flatten things out. I think that if you look at the history of GlobalTranz anyway, we've always been able to sort of power through and grow in excess of the market during some of those volatile periods, because there's opportunities that get created when some of these smaller brokerages or even middle-sized brokerages, can't power through that volatility from a capital perspective. And if you have just a little bit more scale and a little bit more consistency, you're going to be better positioned. And that's kind of how we think about it.
Yeah, well said. Well, Bob, thank you so much for coming on. We'd love to have you back, and would love to invite you to F3, the Future of Freight Festival in Chattanooga this November. Hopefully we can continue this conversation then, and I'm sure we'll see some big announcements between now and then from GlobalTranz.
We're certainly going to try. Thanks for having me on, Craig.
Best of luck for the rest of the year. And also, you can get tickets to F3 in November. Sign up today on the website. The tickets do get slightly more expensive at the end of every month. So in May, the price will go up a little bit. But we'll see you there. It's going to be the freight party of the year.